Hello people, let's revise leverage topic now. Okay, leverage is quite a easy topic, not too many concepts and not too many questions also. Now let's run through and see how soon we can finish this topic because we're all hungry, right? Sure. Now people, leverage, no? In simple terms, leverage means how one financial variable has an impact on another financial variable. How one component has an impact on another component. That's what leverage is trying to study. And which component specifically we are talking about is a fixed cost. How fixed cost has impact on EBIT and EPS. How fixed cost has an impact on EBIT and EPS. That's what leverage study is all about. If there is no fixed cost, then there is no requirement for this topic at all. If there is no fixed cost, absolutely this whole topic you can cut it and throw it. But unfortunately, we will have fixed cost, so this topic absolutely becomes relevant. Okay, that's a meaning. Okay, next, so there are three types of leverage we study here. What are those? Operating leverage, financial leverage, and combined leverage. These are the three leverages we study. Now, people, if you have to draft the income statement from sales, you draft the income statement. Or 1 minute, hang on. Leverage is a study of fixed cost. Hence, now the cost we segregate into two forms. You can analyze the cost in various forms. Like in accounts, we do direct cost, indirect cost. Right? Since leverage is a fixed cost study, the cost we dissect or segregate into these things. We see what portion of cost is variable, what portion of the cost is fixed. Because leverage is a fixed cost study. So in this format, if you're redrafting or putting your income statement, how does it look like? From sales, if you reduce variable cost, what are you going to get? Contribution. From contribution, if you reduce fixed operating cost, we're calling it as FOC. Fixed operating cost will include interest or exclude interest. This will exclude interest. So from your contribution, if you reduce FOC, what number you're going to get? We call it as EBIT. From EBIT onwards, same. Reduce interest, you will get earnings before tax. Reduce tax, you will get earnings after tax. Usually in these sort of problems, preference dividend is not there. So EAT only will become your ESH. Then finally divided by the number of equity shares to get the EPS. Done, Sarji? Now our first leverage, which is operating leverage, measures the relationship between topmost number. What is the topmost number? Sales and EBIT. Operating leverage is trying to measure the relationship between sales and EBIT. Now, financial leverage picks it up from there. It measures the relationship between EBIT and bottommost number, which is EPS. Combined leverage measures the relationship between topmost number and bottommost number. What is topmost number? Sales. Bottommost number? EPS. That's what combined leverage is trying to measure. Yes, sir. Okay, now a little more pointers about operating leverage. So, what did we say operating leverage measures? Operating leverage measures the relationship between sales and EBIT. That's one. Anybody remembers operating leverage ka formula? Contribution mein EBIT. We used to remember it as OL C. OL C. OL for operating leverage. C for contribution. E for EBIT. That is one way. Or another way, in case you have forgotten formula, leverage is anyway what study? Fixed cost study. Now tell me, in this initial stage, or anyway operating leverage measures the relationship between here to here. In this setup, is there any fixed cost you are able to find? Yeah, FOC. FOC is your fixed operating cost. Take one number above fixed cost. Take one number below fixed cost. That's your leverage ka formula. One number above this is what? Contribution. One number below this is what? EBIT. That's your operating leverage ka formula. Contribution divided by EBIT. Clear up? There is another formula to get the operating leverage. Operating leverage again measures the relationship between sales and EBIT. So operating leverage is given by the formula percentage change in EBIT divided by percentage change in sales. Sir, though they say it's degree of operating leverage, both the formula give you the same answer. Whether you use this formula or that formula, answer will be same. Now people, if they give you 1 year data, if they only give you 1 year data, we will use contribution divided by EBIT wala formula. If they give you 2 years data, because this percentage, sir, how do you calculate change? Sir, if someone tells you have changed, how are they saying? They are comparing your new version with your old version. Then only they are saying change. So to calculate percentage change, we need current year data as well as previous year data. So we need one data point or two data points. We need two sets of data to compare and calculate the percentage change. So if they give you two sets of data or 2 years ka data, you can use this particular formula. If they only give you 1 year ka data, you will go for first formula. Or if they directly give you percentage change in the question, sales changed by 40%, EBIT changed by 10%. Like that, if they have given percentage change, then you can go for second formula. Otherwise, we prefer to use contribution divided by EBIT wala formula. Clear, Sarji? Whether you use this or this, answer is same. And some students will get confused because here in this formula, study material uses the term DOL. DOL means degree of operating leverage. Sir, you can call it as OL, as an operating leverage, or you can call it as degree of operating leverage, one and the same. Just because the question says calculate degree of operating leverage, it's not mandatory to use second formula. You can use first formula also. Any formula you can use, both are same. Nana, this is one. Second one, there is another way again to calculate operating leverage using margin of safety. Anybody remembers that? Operating leverage is, we had measured. Remember one example, I had connected the dots. I proved it to you. Here again, we'll just take it. Operating leverage is given by the formula 1 divided by margin of safety. So now basically there are three ways to calculate operating leverage. Depending on the information given, we may use any of the three. Okay, sir. And operating leverage measures business risk. Operating leverage, we say, measures business risk because operating leverage is trying to measure relationship between what to what? Sales, EBIT. Sales and all is affected by your financial decision or business decision. Business decision, like at what price to sell the goods, where to sell the goods, how to sell. All these are influenced more by your business decision. Hence, we say operating leverage measures what risk? Business risk. Clear? And if operating leverage, by chance, if you get it as 2, by chance you calculated operating leverage, you got how much? 2. What is the meaning of that? If you get OL as 2, what is the meaning, interpretation of that? Perfect. Sir, OL measures the relationship between EBIT and sales. So if OL is 2, let's say if sales is increased by 10%, EBIT will not increase by 10%. It will increase twice of that. That means EBIT will increase by 20%. That's the significance. Suppose OL is 4, and sales reduced by 5%, or maybe I'll take a different number. Sales reduced by 7%. Sales reduced by 7%. Tell me what will happen to EBIT. EBIT will also reduce by 7%. No, 4 times of that. What is 4 times of that? 7% into 4. How much is this, people? 28%. But direction is the same. If one increases means other also will increase. If one reduces means other also will reduce. This is what operating leverage is trying to measure. Correct, sir? Any problem on the operating leverage calculation? Easy. Okay. What's the next leverage, people? Financial leverage. Financial leverage picks up from where OL left. Where did OL leave it at? EBIT. So financial leverage picks up from here. From here to bottommost number. What is the bottommost number? EPS. That's what we say. Financial leverage measures the relationship between EBIT and EPS. So this is affected by your financial decision, because after EBIT, what is the fixed cost you pay? Interest. Interest is a financial decision. If you take more debt, you have to pay more interest. If you take less debt, then less interest. I mean, this is a business risk or a financial risk. So hence we say financial leverage measures what risk? Financial risk. So financial leverage is given by the formula, same thing. So financial leverage is measuring relationship between here and here. No? Among here, what is the fixed cost you are able to identify? Interest is fixed every month, no, or every year. Take one number above fixed cost, take one number below fixed cost. That's your financial leverage formula. What is FL ka formula? EBIT divided by EBT. In case you have forgotten, you can visualize income statement and retrace it. That is one way to get financial leverage. Another is your percentage formula. Tell me the percentage formula. Percentage change in EPS divided by percentage change in EBIT. So one of the two you can use to get financial leverage. And it is known as financial risk. Okay, what about combined leverage? Combined leverage is the total risk. This is business risk. This is financial risk. Combined leverage measures the relationship between topmost number sales and bottommost number EPS. Hence, it considers the total risk. So, combined leverage is given with the formula simply OL multiplied by FL. OL multiplied by FL, if you automatically do, you will get the combined leverage. Or you can use percentage formula. What is the percentage formula? What is CL measuring? Sales and EPS. So, percentage formula will be percentage change in EPS divided by percentage change in sales. That also you can do. Done, people? This is all we'll have to do in particular leverage ka formula. Easy. Then a few more things are there. That's okay. And if you want this, we say financial leverage is a double-edged sword. Financial leverage is influenced by finance decision, no? As in taking debt. Sir, when you take a debt, it's a double-edged sword. Double-edged sword means what? That end also sharp. This end also sharp. You can use it and go like this, or you can also go like this. It can harm others and as well as it can harm you also. So that is what we mean by double-edged sword, because taking a debt has advantage also, taking a debt has disadvantage also. What is the advantage of taking a debt? Compared to equity, it is costly or cheaper? So it's a cheaper source of finance. And on this debt, you get a benefit called tax advantage. Disadvantage. Is debt permanent capital or company has obligation? Obligation to pay interest also, obligation to pay principal also. Okay, now what if company does not have money to pay EMI? What will happen? It's a good thing for a company or bad thing? So if company does not have enough money to pay the interest, then eventually company may shut down. That only we call it as bankruptcy cost. Bankruptcy cost is a scenario where if you don't have enough money to pay the debt, then debt guys will start selling the assets. When the assets of company are getting sold. Now, if somebody takes away our laptop or iPad and all, can we conduct class? Difficult, no? So, ultimately, we may become, hopefully, no? Yeah, I'm just saying. So, bankruptcy cost. That's your bankruptcy cost. Done, na? So, these are some disadvantages. That's what we mean by double-edged sword. Taking an debt has advantage also, disadvantage also. And one more way they ask the theory question is, they will say, okay, they will ask you to calculate and say whether it's a financial leverage or favorable leverage or unfavorable leverage. Now, people, here how do you calculate that is, compare the return on investment. When you're doing a particular project, you will get a return, no? That we call it as ROI. What's the return? Just now, previous chapter may be computed. ROS. ROS is a return. So, compare the ROS with the cost of debt. Here we're talking about debt, right? Right? Because fixed cost comes on equity shares or debt? Debt. So compare if the rate of return on investment, if the R, we call this as R, if the R is greater than your interest rate. If the R is greater than your interest rate. Here you need to be a little careful. One thing is some mistake people can do. Sir, ROS you can calculate on a before tax basis, or you can calculate ROS on a after tax basis. We have done this in ratio analysis topic. If you remember, there are two formulas to calculate ROS. One on a before tax basis, another one on a after tax basis. Now, if at all, if they give you in the problem, ROS on a before tax basis, ROS on a before tax basis, will you compare with KD? KD is always on a after tax basis. If one is a before tax basis, can you compare other one on a after tax basis? Are they comparable? No. If you take ROS on a before tax basis, then you will compare this with what? You'll compare with KD or you'll compare with interest rate? You'll compare with interest rate. If this is greater than the interest rate, then we say it's a financial leverage or a favorable financial leverage. If you take ROS on after tax basis, now you will compare with the interest rate or cost of debt? Cost of debt. If the ROS is greater than the cost of debt, then it will become what, people? Favorable financial leverage. If it's other way around, if it is lesser than the cost, then it will become unfavorable. This is a one marker theory question. Usually they will fit in this in the bigger question. Understood? So be careful on what you are comparing. If you take one number on before tax, other number also should be before tax. If one number is after tax, other number also should be after tax. Now this scenario, tell me, what does it lead to? It's unfavorable or favorable? If simple, interest rate is a cost, ROS is a return. If return is a greater than cost, it's a sad news or happy news? Happy news means unfavorable or favorable. So this we call it as favorable financial leverage. Done now. If it's other way around, what is the other way around? What is the other way around? If ROS on a before tax basis, if it is less, now you'll compare, if this is on before tax basis, you'll take KD or interest rate? interest rate, or rows on a after tax basis. Rows on after tax basis, you will compare it with interest rate or KD. If it is lesser means what does it lead to? Favorable or unfavorable? Rows is a return, interest is a cost. If return is lesser than the cost, what does it lead to? Unfavorable financial leverage. Okay, Sarji. Done. This is another one. No? Okay, moving on to the next. Now, another one is, this is okay, not that great. Okay, I'll move on to this. There are a couple of more formulas you need to remember for leverage. Leverage hardly 6 to 7 formulas if you remember, good enough. One is break-even point. Sir, how do you get break-even point? 1 second. We have already done financial break-even point in capital structure topic. Now, here also they're saying break-even point. Okay. Now, people, can you find operating leverage through margin of safety? Can you find operating leverage using margin of safety? Yes. How? Operating leverage is given by the formula 1 divided by margin of safety. In order to calculate margin of safety, we also need break-even point. Okay. And operating leverage stops at what? It measures relationship only between sales and EBIT. Yes, no? I mean, this is financial break-even point or operating break-even point. Here, when we say break-even point, it is not financial break-even point, it is operating break-even point. So, what we did in capital structure and what we are studying in leverage, both are same or different? Financial break-even point means, tell me once again, what does it mean? Financial break-even point means how much should be EBIT so that EPS becomes zero. Here, operating break-even point means how much should be the sales so that EBIT itself becomes zero. Here, the goal is to make EBIT zero. Clear, everybody? So, in leverage, since break-even point helps us to calculate margin of safety, and margin of safety helps us to calculate operating leverage. This is not a financial leverage. This is a operating break-even point. That's the first thing. Now, how do you calculate break-even point? There are two formulas you must have done in your costing. If you want break-even point in units, how do you calculate? Fixed cost divided by contribution per unit. I derived this formula also for you in case you remember regular. Now it's anyway fine. Fixed cost divided by contribution per unit. If you want break-even point in value, then fixed cost divided by contribution percentage. That contribution percentage only we call it as PV ratio. How do you calculate GP percentage? GP percentage. Normal gross profit percentage. GP by sales into 100. Similarly, contribution percentage, you tell me. Contribution divided by sales into 100. That only we call it as profit volume ratio. PV ratio. You can call it as PV ratio or you can simply call it as contribution percentage. Done, sir. So, if you want break-even point in value, this formula. If you want break-even point in units, this particular formula. But we'll need for leverage this one. Okay. How do you calculate margin of safety? Tell me once again. In fact, I used to tell you, break-even point means no profit, no loss. Margin of safety means profit zone. Margin of safety means profit zone. Now, let's say if you want just for 1 minute, I'll quickly explain this. So, let's say people, total sales, let's say is 10 lakh rupees. Total sales is 10 lakh. Let's say break-even point, not in units, but in value is, let's say 7 lakh rupees. Is 7 lakh rupees, correct? Just an assumed number. Now, people, if you analyze, what is the meaning of this? What is the interpretation of this? Can you help me out? Up to 7 lakh sales, there is no profit, no loss, because in up to break-even point, what will happen? You will get profit or EBIT will be zero. EBIT will be equal to 0. Agreed? That means profit zone starts from where? Profit zone starts up to 7 lakh or beyond 7 lakh? Beyond 7 lakh. This we call it as margin of safety. At profit zone, we call it as margin of safety. Yes, sir. Now you tell me, people, how did you get this profit zone? How did you get this 3 lakh? Can you express an equation for me here? You did 10 lakh minus 7 lakh and you got 3 lakh. Tell me that in the same equation. Total sales minus break-even point in units of value now. If you do that, what are you going to get? Margin of safety. I want margin of safety in percentage. Tell me, how do you calculate? Same like GP percentage. How do you calculate? GP by sales into 100. Margin of safety in percentage will be margin of safety divided by total sales into 100. That is your margin of safety in percentage. Total sales minus break-even point sales. Total sales minus break-even point sales. The moment you do this, what are you going to get? Margin of safety in amount. We don't want it in amount. We want it in percentage. So divide this by what? Total sales. That's all. Okay, Sarji. That's your margin of safety ka formula. Any doubt or sorted? All right. This is one. Another couple of things we should not forget in leverage wala formula is this. You see this in majority of the leverage wala question. I'll not worry about this and all. It's fine. That's okay. Now we'll focus on the things more which are exam oriented. Now people, in leverage problem, usually examiner will not ask you straightforward leverage question. Like they'll not give you data and say calculate OLCLFL. It will be missing find the missing figure wala question. Right? They will give you some data. Some data will be missing. You'll have to figure out what data is missing and construct a balance sheet or an income statement. You have to prepare an income statement or a balance sheet. Usually that sort of questions are expected from the leverage. So there will be some missing figures. Okay. So in such question, there will be some connections between the two things. One important connection which you can find in majority leverage question is this. In the question, they will say, they will give you FL and they will give you interest. They'll give you financial leverage as well as interest. Tell me financial leverage ka normal formula. EBIT divided by EBT. EBIT divided by EBT. Visualize your income statement. Tell me from EBIT. Give me the income statement. Normal. From EBIT, if you reduce interest, what are you going to get? EBT. Stop there. Tell me that once again. From EBIT, if you reduce interest, what are you going to get? EBT. That means, can I substitute? Instead of EBT, I can write EBIT minus interest. Financial leverage will be given to us in the problem. Interest is already given in the problem. It means by doing the substitution, we can find what? EBIT. This is one connection which you see in many leverage wala problems. So instead of writing EBIT divided by EBT, financial leverage, we will rephrase. How will we rephrase it as? Keep the EBIT as it is. Instead of EBT, we will write what? EBIT minus interest. Financial leverage given, interest given. Through this, we can solve and get EBIT. That is one connection. Can I move on? Another way, there is a connection between operating leverage also. Tell me operating leverage ka formula. Contribution divided by EBIT. 1 minute. Go back to income statement and call out the income statement from sales for me. Sales minus variable cost. Contribution. Contribution less fixed operating cost gives you EBIT. That portion once again. Contribution less fixed operating cost is EBIT. That means instead of, what is the normal formula for OL? Contribution by EBIT. Instead of EBIT, can I substitute? What I can substitute? Contribution minus FOC. You'll use this connection in the problem because they will give you OL and FOC. In the problem, you will see they would have given you operating leverage and FOC. Now, instead of EBIT, if you substitute it as contribution minus FOC. FOC given, OL given. So, using this, what you can find? Contribution. This is also a good connection. You will use this when operating leverage and fixed operating cost is given in the problem. This is more popular. This you will also see in few problems as well. So, don't forget this. Sometimes in leverage, you get stuck. When you're getting stuck, think on this and this. One more thing is, leverage, if you're still getting stuck, the best way to solve, according to me, leverage question, missing figure is, have the income statement. Have the income statement. Because when you prepare the income statement, few things automatically you'll be able to solve. I've proved it like at least 4 or 5 questions. In fact, every problem we have solved using income statement in our regular class. Right? So, if you're getting stuck, try to go with this approach. Fine, people. I think that's pretty much about leverage, people. Now we have some questions. Before that, can we quickly recap? So leverage is basically a study of what to what. How one financial variable influences another financial variable. Which variable are we talking about? Fixed cost. Due to fixed cost, how your EBIT and EPS is going to get impacted is what leverage is trying to study. 3 types of leverage. Operating leverage, financial leverage, combined leverage. Operating leverage measures the relationship between sales and EBIT. Operating leverage, we call it as business risk. And operating leverage ka another formula is percentage change in EBIT divided by percentage change in sales. Another formula for operating leverage, 1 divided by margin of safety. And how do you get margin of safety? For that, first we need break-even point. If you want break-even point in units, formula is fixed cost divided by contribution per unit. If you want break-even point in value, Fixed cost divided by contribution percentage, or you can call it as PV ratio. How do you get PV ratio? Contribution upon sales into 100. Now, how do you get margin of safety? Total sales minus break-even point sales divided by total sales. That is your margin of safety. Financial leverage measures the relationship between EBIT and bottommost number EPS. So, financial leverage is given with the formula EBIT divided by EBT. One simple way to get it is one number above fixed cost, one number below. Okay, another percentage formula for financial leverage is percentage change in EPS divided by percentage change in EBIT. Financial leverage we refer to as financial risk. Combined leverage measures total risk and it measures the relationship between topmost number sales, bottommost number EPS. So, combined leverage is given by the formula OL multiplied by FL. Or another formula for combined leverage is percentage change in EPS divided by percentage change in sales. Okay. All right. And don't forget another connection. If financial leverage and interest is given. If financial leverage and interest is given. Normal way for financial leverage formula is EBIT divided by EBT. Here we will substitute. Instead of EBT, we will write it as EBIT minus interest. Another is operating leverage will be given. FOC will be given. What is the normal formula for operating leverage? Contribution by EBIT. Instead of EBIT, here we will substitute as contribution minus FOC and get the contribution. That's quick fix. Maybe one more point you need to remember here is, now people, these three numbers, or you could say, yeah, these three numbers, they go hand in hand. These three numbers go hand in hand. If this increases by 10%, variable cost also will increase by 10%. Contribution also will increase by same. We have proved it to you with numbers. First example, if you remember, teacher example I had given. Some of your new students, you will not be able to collect that. Now, these three will go in same direction. If one reduces by 10% means all will reduce by 10. One increases by 20 means all will increase by 20%. That's what I've written here. Go hand in hand. Girlfriend, boyfriend, these are. Okay. Sales till contribution. Similarly, from earnings before tax till EPS, from EBT up till EPS, all this will go hand in hand. From EBT up till EPS, meaning let's say EBT increased by 20%. What will happen to EAT? That will also increase by 20%. What happened to EASH? 20% increase. EPS also will increase by 20%. All same direction. From what? EBT to EPS. We proved it in the regular example. Now it's okay. Leave. This connection is important to people. This is a popular question from leverage. This connection. We'll solve one question also. I'll tell you. Can we move on? Okay. Next. I think we'll take up questions. So yeah, we'll try to do as many questions as possible in the before you become angry or whatever it is. Now, question number 9, again study material question. This is very simple question, but I don't know why ICAI this is in one way it is one favorite. I think even in this attempt RTP or MTP same question is there. Just a name or some values are changed. This is there in many RTPs, MTPs as well as previous year paper. Just because it is repeated multiple times, I am doing it. Otherwise, very faltu question actually. Capital structure of the company they have given. They have equity share capital how much? 10 lakh. Each share ka face value 100. So how many shares we have? 10,000. 10 lakh divided by 100. That is 10,000 shares. We have similarly debentures also. How much debenture? 10 lakh face value. That's fine. Now during the year, keep in mind during this is which year? 2021. That means what is the whole year? 1st April 2020 to 31st March 2021. That is your 2021 wala year. During this year, current year, sales has decreased to how many units? 1 lakh units compared to 1,20,000 units in the previous year. Last year, total units sold was 120. Current year, it is only 1 lakh. Fine. Sales they were given not in value but in units. What is the selling price per unit? Well, then it's easy, no? You take the number of units and multiply selling price. What are you going to get? Total sales of both current year as well as last year. Variable cost for 1 unit is 8 rupee. Sales minus variable cost again is contribution. So contribution also you can find it. Fixed expense were 2 lakh. Sir, in this problem, on this sort of problem, when they say fixed cost, it is always fixed cost excluding interest. Even though they say fixed expense, it is always what? FOC. That means including interest or excluding. How much is that? 2 lakh. Interest rate is 30%. Now you need to calculate OLFL at 1,20,000 units as well as 1 lakh units. That means they are asking OLFL for current year and last year. Sales, you know. Variable cost, you know. Sales minus variable cost is contribution. Contribution minus FOC is EBIT. You know already the debt value also. Where it went? Here. You know the debt value also. That means easily you can find everything. Any difficulty in this question? Faltu question just given. Quickly we will review. First, previous year. Previous year, how many units? 1,20,000. Current year, how much? 1 lakh unit. We want in units or value? Value. What? 1,20,000 units we have sold at what price per unit? 12. So last year sale was 1440. Current year it is 1 lakh into 12, which is 12 lakh. Variable cost per unit is 8 rupees. Sales minus variable cost is contribution. Minus FOC. So fixed cost will keep changing year and year, or it will be same? It will be same every year. What is the fixed cost they have given? 2 lakh. For last year also 2 lakh. Current year also 2 lakh. From contribution, if you reduce FOC, you will get EBIT. From EBIT, you will reduce what? Interest. How much debt has this company taken? 10 lakh. What is the interest rate? 10%. So how much is the interest? 10 lakh ka 10%. Interest is 1 lakh. Same. Fixed cost, so same. From EBIT, reduce interest. You will get EBT. Tax rate given 30%. So EBT minus tax will give you EAT. Profit after tax. Since there is no preference dividend, this only will become what? Each. Each divided by number of equity shares will give you EPS. So far any problem? Now calculate, people. How do you get OL? How do you get OL? One number above fixed cost, one number below. So contribution divided by EBIT. 480 divided by 280 for last year. How much? 1.714. For current year, how much is it? 4 lakh divided by 2 lakh. How much? 2. That's for the current year. What about financial leverage? How do you calculate financial leverage? One number above fixed cost, one number below. EBIT divided by EBT. 280 by 180. 1.56. Current year. 2 lakh divided by 1 lakh. 2. Combined leverage not asked. If that asked means we would have multiplied those two. Okay. One more requirement they asked in question. What is that? Percentage change in EPS. Sir, leverage problem you can solve in multiple ways. You don't have to solve just like the way I'm showing. You can do other things also. Now, percentage change in EPS. How am I calculating is? First, if you want, you can calculate combined leverage. Because combined leverage measures the relationship between sales and EPS. Like that also you can calculate. Or I'll prefer to do it direct way. Last year, people, how much was EPS? 12.6. Current year, how much is it? 7. Last year, 12.6. No, yes, no? Current year, how much? 7. That means EPS changed. Yeah. It increased or reduced. From 12.6, it has become 7. So it has reduced. They did not ask EPS ka reduction. They asked change in EPS in percentage. We already did in cost of capital growth rate. Remember? How do you calculate? Change in amount. Numerator will be change in amount divided by original amount into 100. That's what I've written here. Change amount divided by original amount into 100. From 12.6 it has become 7 means what is the change? 5.6 is the reduce divided by original amount. Guruve, don't take original amount 7. Original amount means last year. Last year how much was EPS? 12.6. So how much is it? 44.44. EPS is increased or reduced? Reduced. Because here EPS is reduced. No? From 12.6 it has become 7. So this is the reduction in EPS, which is how much? 44.44%. That's what they've asked. Problem over. Need a minute to review or sorted? Pretty straightforward question. Just repeat it, so we have done. This is a good question. Remember I said some things go hand in hand? Call it out for me. Sales to variable cost to contribution. All this will change in same direction and by the same percentage. Then EBT to EPS. EBT to EPS. Everything will change in the same direction. Keep that in mind. EBT to EPS. Now that in mind, read this question. There is a couple of other ways also this question can be asked. I'll tell that to you later. First, let's review this question. Sales of this company called TM Excellence is how much per unit? 20 per unit. And is 20 lakh rupees. So selling price per unit is 20. This is rupees 20 lakh means this is the number of units or value. Sale ka value 20 lakh, selling price per unit is 20. So if you do 20 lakh divided by 20, you'll get 1 lakh units sold. Correct, Ajay? Contribution, how much, G? 10 lakh. Sales minus variable cost is your contribution. Yes, no? Sir, yeah. So if they've already given sales, if they've already given contribution, can't you find out variable cost? As a balancing figure, you can find out if required. Check this. At present level of output, under current scenario, DOL means degree of operating leverage is how much? 2.5. Now, just because they have given DOL, we'll have to use percentage formula or any formula? Any formula, it doesn't matter. Basically, operating leverage is 2.5. Stop there only. What is operating leverage ka normal formula? Contribution by EBIT. Operating leverage is given. Contribution is given. So using this, what you can find? EBIT. So that means first working out you already sorted. Read the requirement of the, or maybe I'll go one line by line, it's fine. The company does not have any preference shares. Even if they don't say, we will assume the same. The number of equity shares is how much? 1 lakh. Applicable income tax rate is 50%. Interest rate on debt is 16%. What, read this line carefully, this is a requirement. What is the EPS? What is the EPS at sales revenue of 20 lakh? Currently, what is our sales? 20 lakh. So currently, at current level, they are asking EPS. They have given sales, but to calculate EPS, we need sales or Isha. We need Ish. That means from sales, we have to first arrive at Ish. Right? So that's where income statement comes into picture. Okay. And then you will be able to calculate the EPS. That is one requirement. Second, they are asking amount of debt capital. Amount of debt capital. Amount of debt capital means they are asking debenture ka amount. Okay. 1 minute, people. Is there any way to find out debentures? We have done this. Is there any way to find the debentures? Interest amount divided by expected interest rate. Here expectation, actual are same. How much is that? 16%. If you just find interest amount, I think we'll get that from income statement. You have interest amount, you have interest rate. That means easily you can find out debentures. Okay, now last part is the most important part of this question. If a 25%, the key word there is if. If means it has happened or hypothetical case. If this happens, if sales reduces by 25%, decline in sales, then what will happen? It will wipe out EPS. It will wipe out EPS. Wiping out EPS means EPS will become 0. If 25% reduction is there in sales means EPS will wipe out. That means can I say there is a 100% change in EPS? Why? Yes, no, everybody? If you have not got it, no issues. Here, let us say EPS was 5 rupees. EPS was 5 rupees. If sales reduces just by 25%, if sales reduces just by 25%, why 25%? The question told. Then what will happen to EPS? It will wipe out. It will wipe out means now EPS will become how much? 0. Correct? Huh? From 5, it will become 0. Calculate the decrease percentage for me. If you want it in formula only. How do you calculate the percentage change? Change amount. Change amount andre? From 5, it has become 0. From 5, it has become 0. What is the change amount? 5 minus 0 is how much, people? 5. So change amount is 5 divided by original amount. Originally, how much it was? 5 into 100. How much is this? 100%. Yes, sir. So when I wipe out EPS means obviously how much percentage change is there in EPS? 100%. 100% increase or 100% reduce? 100% reduction. That's what wiping out EPS means. There is a 100% reduction in EPS. Everybody got it? Pakka. Now 1 second, hang on. We are discussing the chapter of leverage. Is there any leverage which measures? Always, no? Keep the topic in mind so that you will be able to establish the connection. Here the topic is leverage. They're talking about sales and EPS. They're talking about sales and EPS. Do we have any leverage which measures the relationship between sales and EPS? Combined leverage. What is here? They've given percentage change, no? So that means we will use which formula? Percentage wala formula. Tell me combined leverage ka percentage formula. Percentage change in sale. Percentage change in rather EPS divided by percentage change in sales. How much percentage change in EPS is there? 100%. How much percentage sales change is there in sales? Numerator changes 100%, denominator changes 25%. So therefore, combined leverage is what? Indirectly, they're telling combined leverage is 4. They could have directly told combined leverage is 4. Instead of telling that, they've given this. This last line is to say combined leverage is 4. Goinda, got it. Pakka. Now people, you know OL, you know CL. That means using these two you can find FL. Then you can figure out the missing components. That wala problem. Done now. First I'll do this. After that, remind me once about this line once again. I'll tell you at the end when they can rephrase this in another way, which they've done. First, let me finish this. I prefer, since I've asked EPS, I prefer to always put up what? Income statement. So first let's do income statement. I always prefer to, in fact, if you remember regular class, we always used to follow this format. Particulars, amount, and one working call. If it is very simple working, we will show it here only. If it's a little more, then we will put up a separate working note. That wala. Okay. First have the income statement format. First you do it. What's the income statement format in leverage? Mein? Sales. Sales minus variable cost. Contribution. Contribution minus FOC. EBIT. EBIT minus interest. EBT. Reduce tax. EAT. Preference dividend not there. So, EASH. That divided by number of equity shares gives you EPS. Have this format. They would have given you some values. Whatever value they have given in the question, first fill it out. Here, what and all we saw? Sales we saw 20 lakh. Contribution we saw 10 lakh. So this is given, this is given. Fill it out. That means you tell me, is variable cost difficult for us? Huh? Sales minus variable cost is contribution. If this number is 20 lakh given, this number is 10 lakh given, variable cost has to be what? 20 lakh minus 10 lakh, which is what? 10 lakh. This is complex working or simple? Show it here only. Done now. Now FOC given or not given? Let it be. Fine. Anything else they gave? Check the question. Anything else they gave? We can fill it out. Nothing they've given. Yes, no? That's pretty much what they've given. Okay, now we'll have to figure out the missing components. First, operating leverage was given as 2.5. Have they also given contribution? What is operating leverage ka formula? Contribution by EBIT. So we use this connection first as a working note. Operating leverage is contribution by EBIT. Operating leverage given, contribution given. Therefore, using this you can find EBIT. How much is that? 10 lakh divided by 2.5, which is 4 lakh. Immediately when you get the data, go and fill up the income statement. Now EBIT, you got it from working note number 1. How much is that? 4 lakh. Now you know contribution, you know EBIT. Can't you find out FOC? This is 10 lakh, this is 4 lakh. Now if you don't put up income statement, you'll never be able to figure out what is FOC. Because it will not click that this minus this is your FOC. But when you put income statement, you automatically can get it as a balancing figure. So this is 10 lakh, this is 4 lakh, means FOC has to be what? 6 lakh. Sorted. So till here we have filled out. Can we move on to the next? Now again this question. They said 25% decline in sale will cause EPS to wipe out. Wiping out EPS means what, sir? 100% decline in EPS. Now EPS and sales, which leverage measures? Combined leverage. In percentage formula, what is that? Combined leverage is given by the formula percentage change in EPS divided by percentage change in sales. EPS is reduced by 100%, sales is reduced by 25%. So therefore, combined leverage is what? 4. We found that. What is a normal way to find combined leverage? OL multiplied by FL. OL multiplied by FL. Combined leverage you know, OL you know, can't you find out FL? So therefore, how do you get FL? Combined leverage divided by operating leverage. You do, you will get the financial leverage. Easy. And what is a normal way to calculate financial leverage? EBIT divided by EBT. EBIT divided by EBT. Now, do you know financial leverage? Yeah. How much? 1.6. I think you already found EBIT. How much is EBIT? 4 lakh. So, this one you know EBIT you know. Can't you find out? EBT. So, EBT is missing figure. Find it out as what? 2,50,000. Yes, sir, Sirji. Go ahead and push it. EBT is how much now? EBIT found 4 lakh. So EBT is 2,50,000. If this is 4 lakh and this is 250, can't you find out interest? Balancing figure. What is that? 4 lakh minus 250. How much is that? 150. Tax rate is 50%. Now onwards, simple. From 2,50,000, calculate 50%. You will get this. Yes, sir, people. Preference dividend is not there. Number of equity shares is given to be 1 lakh. You will be able to find out EPS normally. You just need to figure out what to start with. Then automatically each component will keep falling in leverage. That is your thing. Yes, sir, people. Did we solve the requirement, or what was the requirement here? What is EPS? I think EPS we have found. Next, they also asked what? Debt capital. Debt capital means they are asking you the debenture ka or debt ka value. How do you find that? Interest amount divided by interest rate. Do you know interest amount? Yeah, we got it from income statement. How much is that? 1,50,000. Interest rate is 16%. Interest amount is 1,50,000 and interest rate is 16%, 9,37,500. Problem solved. Clear, people? Paka? Now, same question they've asked one more way in previous year, some paper. Can I tell you what that is? Now, people, I told you something goes hand in hand. Sales, variable cost, contribution. Okay, that is over. Next. EBT, EAT, EASH, EPS. Here they have used EPS will wipe out, no? Instead of saying EPS will wipe out, they may say EBT wiped out. Or they may say earnings after tax wiped out. Or they may say EASH wiped out. Or they may say EPS wiped out. One and the same. Instead of EPS, if they use any other number, or usually in that problem, they'd use net profit. Net profit means PAT. Net profit always means PAT. Whether you say profit before tax, profit after tax, or you say EASH, or you say EPS, it is one and the same. Instead of EPS, they'll substitute with one of those four numbers. But any differently you will calculate or same. If EBT is reduced by 100% means EPS also will reduce by 100%. One and the same, absolutely same step. Done now. This they've done. Instead of EPS, they've substituted in one examination paper with net profit. Net profit is simply your PAT. Same step, no change. So watch out for that. Done, sir. Okay. Can we review one more question? We have the energy left. I would want to do two more. Can I try two more? Two is okay. Alright. This is also easy question but good presentation. So I would like to run through this question. Calculate OL, FL and CL from the following data. Under situation 1 and situation 2. Plan A and plan B. Two situation, two plans. That means you have to calculate the data. How many? 4 cases. Now check. Installed capacity is 4,000 units. Installed capacity means we have a capacity to produce totally how much? 4,000. Sir, just because we have capacity to produce 4,000, should we produce 4,000 or our choice? So how much did we actually produce? Check. Actual production and sale is only 75% of our capacity. So our capacity is 4,000. 4,000 ka 75% is how much? So actually we produced and sold in the current year only 3,000 units. Selling price per unit is, this is the number of units sold. What is the selling price per unit? 30. So you can find total sales. Variable cost is given. Sales minus variable cost gives you contribution. Fixed cost, no people. If it is first situation, fixed cost will be 15. If it is second situation, they are telling 20,000. Okay. Based on financial plan means what? Financial plan means raising the money. You can raise the money through equity or you can raise it through debt, any combination. Tell me, because of that, this is your FOC. FOC means what? Fixed operating cost. Will this change due to your financial plan? Due to your financial plan, which fixed cost will change? Interest. But FOC will change or no impact? FOC will not have any impact. Done now. Now, if you go for, there are two financial plans, A and B. If you go for financial plan A, you will take how much, you will raise how much money through equity? 10,000. How much money through debt? 10,000. So, totally how much money you require? 20,000. And debt will come at what interest rate? 20%. Calculate the interest for me. What is the interest for me? If you go for plan A, 10,000 will be debt amount and interest rate will be 20%. So 10,000 ka 20% is 2,000. If you go for plan B, how much money will come through equity? 15,000. Correct only, no? If we go for plan B, how much money will come through equity? 15,000. How much money will come through debt? 5,000. Sir, 5,000 is a debt to, and how much is the interest rate of? 20%. So how much will be the interest amount? 5,000 ka 20%, which is 1. So based on your plan, what number is changing? interest amount is changing. Under plan A, interest is 2000, plan B, interest is 1000. So it's a simple question, just the format is thing you need to worry about. Operating leverage stops at where? Can you tell me? It considers from sales to EBIT. Based on your financial plan, what is the only data changing? Interest. Will operating leverage consider interest or it stops at EBIT? EBIT ka very full form is earnings before interest and tax. That means this will have any impact on operating leverage or no impact. That means I will not calculate operating leverage plan wise because plan is irrelevant for me. Correct? No. I will calculate operating leverage what wise? Situation wise, because based on the situation your FOC is changing. It's just a matter of presentation. Okay. So how we'll present the operating leverages? We'll present it what way? Situation wise. To calculate operating leverage, I need what and all? Contribution, EBIT. Have they given or have they given sales? How much is the unit sold? 3000. How much is the selling price per unit? 30. So what is the total sales? 90,000. Done now. Okay. Whether it is situation 1 or situation 2, only one data will change, which is FOC. Sales will be same. What is variable cost? Variable cost per unit is how much? 15. How many units have you sold? 3000. So calculate 3000 ka 15. How much? 45,000 is a variable cost, both the situation. Sales minus variable cost is contribution. Contribution also same. Done now. Any problem? From contribution you have to reduce FOC. Now be careful. If it is situation 1, how much is FOC? 15. If it is situation 2, 20. We are solving situation wise. First situation 15, second situation 20. So FOC for the first situation will be 15, FOC for second situation will be 20. Contribution minus FOC will give you EBIT. Any problem? Now how do you calculate operating leverage? Contribution divided by EBIT. 45 divided by 30 is 1.5. 45 divided by 25 is 1.8. What about plan wise? Should I have to worry about operating leverage, financial plan A, financial plan B, or irrelevant? Irrelevant, because financial plan A only impacts your interest. Is interest relevant for operating leverage or irrelevant? So that means operating leverage is only influenced by, in this problem, what? Situation 1 and situation 2. It is not impacted by financial plan A and B. Any problem? Clear or sorted? Now they asked only 1 or 3. OL, FL and CL. Next is to find out what? FL. Now FL, no people. For FL we need EBIT as well as. What is the formula for FL? EBIT divided by EBT. Correct? Huh? That means FL is impacted by interest. Do you agree with me? Because how do you get, tell me, from EBIT, how do you get interest? From EBIT you reduce interest and you get EBT. And interest changes as per the plan. Interest amount changes as per the plan. Correct? No. Now people, can I present the data only situation wise or also plan wise? Plan wise. Now financial leverage onwards, I'll present it plan wise. The way that they've given the data. Plan A and plan B. Check the careful presentation here. Financial leverage, I'm presenting it what way? Plan wise. Now first, I'll try to solve financial leverage of plan A under which situation? Situation 1. Like this. Plan wise, situation wise. Individually we'll have to go. Okay. Here just picking the right number is the crux over here. Remaining things are very easy. Sir, 1 second. We are in which situation? Sir, if it is situation 1, EBIT will always be how much? 30,000. Whether you are in plan A or plan B, doesn't matter. If you are in situation 1, EBIT is always what? 30,000. So EBIT, I'll copy both. Once more or got it? Once more got it. From EBIT, we have to reduce what? Interest. Now interest will be same under both the plan. Now we have already calculated. Here check. If you are in plan A, what is your interest? 2000. If you are in plan B, interest is 1000. So copy. For plan A, interest is 2000. For plan B, interest is 1000. From EBIT, if you reduce interest, you will get EBT. Now can you calculate financial leverage? How? EBIT divided by EBT. So divide 30,000 divided by 28,000. How much? 1.17. 30,000 divided by 29,000. 1.03. Correct? Now once again, you calculated financial leverage for both plan A as well as plan B. But for which situation? Situation 1. We have only one situation or one more. Now the same calculation, now we have to do it for situation 2. If it is situation 2, what is going to be your EBIT? Your EBIT is always going to be 25. Same. If it is situation 2, EBIT is always going to be 25 under both. Correct? Huh? Interest you already know. For plan A, interest is 2000. Plan B, interest is 1000. Reduce 2000, 1000, you will get EBIT. How do you calculate FL? EBIT divided by EBT. 25 divided by 23. 25 divided by 24, 1.04. This is calculating FL both plan wise as well as situation wise. Done, Sarji. Now, why I did not do the same presentation for OL? Based on the plan, based on this financial plan, what is changing? Interest. Is interest required for OL or not required? Not required. That's the reason we stopped at what? Situation level. Done now. Now, last thing. What is last now? Combined leverage. Combined leverage, we need OL also, we need FL also. I mean, whatever presentation you did for FL, same presentation I'll continue for CL. Tell me that presentation. Particulars, plan A, plan B. Then situation 1. Now be very careful, just again picking the number. How do you normally get your combined leverage, people? OL multiplied by FL. Okay, now careful here. We are in which plan? Financial plan A. We are in which situation? Situation 1. Careful. If it is situation 1, OL is always what? 1.5. Plan can be anything. Plan can be anything. If it is first situation, OL is always what? 1.5. Now, we are in first situation. That means OL is going to be 1.5 and 1.5. Because OL varies only based on situation. If it is first situation, again, if it is first situation, operating leverage will always be what? 1.5. Now we are in first situation scenario. So OL will be 1.5, 1.5. Done now. But for combined leverage, we need OL also, we need FL also. Now FL varies based on situation as well as based on plan. Now, if you are in financial plan A and if you are in situation 1, what is your FL? 1.07. 1.07, correct. Same thing over here. If you are in financial plan A, if you are in situation 1, what is your FL, people? Here we just now got to 1.07. So multiply 1.07. That's your combined leverage. Easy. Same. Now if you are in plan B, if you are in financial plan B and if you are in situation 1, what is your financial leverage? 1.03. Now your financial leverage will be 1.03. That way you will get the combined leverage. Any problem? And now let's see how well you have understood. I'll show you the data. Now you calculate the CL for me. Plan wise, situation wise. Take 1 minute, calculate. Let's see. I want to see whether you have really got it or Buddha Zona has come. I'll show you the data. Or maybe if you want, this is visible. For situation 1 and 2, OL is 1.5, 1.8. If you want, you can have that data somewhere, written it down. Now, if it is situation 1 and 2, OL is 1.5, 1.8. Now, if it is plan A, plan B, situation 2 ka FL is 1.08, 1.04. Situation 2 ka FL is 1.08 for plan A, 1.04 for plan B. Note this data, calculate CL for me. For situation 2, you will need to calculate combined leverage for me. Let's see. Situation 2 ka combined leverage. I don't know though, I'll check. You calculate. You note it down somewhere. 1.62. 1.62, 1.872. Yes, so I don't know answer. 1.872 is right. 1.944 is the first answer. 1.944. Okay, perfect. Now, how do we calculate again? Now, same. If it is second, for combined leverage, what do we need, people? If you're confused, for combined leverage, what do we need? OL and FL. If you are in second situation, OL will always be what? 1.8. You can be in plan A, plan B, doesn't matter. If it is second situation, OL will always be 1.8. So fill up the OL. 1.8, 1.8. Now only thing we need to multiply is what? FL. Now FL we are doing for which situation? Situation 2. For plan A, situation 2, FL is 1.08. So multiply 1.08. Same. For plan B, situation 2, what is FL? 1.04. So multiply 1.04, you'll get the answer. Done now. That's all. This whole crux is on the presentation here. Same question in one of the RTP, they asked for 3 plans. Here we solved how many? 2. There they asked for 2 situations, but 3 plans. That means here you will have to add one more column. Financial plan C. For operating leverage, should you have to add anything or same? Same. Method of solving is same, just that one financial plan has got it added extra. Done. Last question. Chudama, Paglama. Everybody okay? I'm saying, finally, Jai Allah Jesus Shiva. Finally, he's decided to leave. Okay, question number 18. Question number 18. Question number 18. Oh, in our book, I think it's a RTP May 24 wala question. So what is this? Just check. From the following financial data, prepare the income statement. You just need to prepare income statement. You already know income statement ka order. So what you do is first make the format. And whatever data they have given, fill it up. Missing figures, we will get it as a working note. First, let's do it for company A. Here, people, you need to prepare income statement for company A as well as company B. Everybody check the screen. For company A, variable cost given, fixed cost given, interest given, financial leverage they are saying is 5:1. 5:1 means simply 5 divided by 1, which is what? 5. They can say financial leverage is 5, or simply they can say 5:1. Okay, now, or another presentation if they want to, they can say is 10:2, they can say. 10:2. 10:2 means 10 divided by 2, which is again what? 5. Usually they will not say like that. They'll use one wala presentation. Either directly they will say 5 or they will say 5:1. Okay. And now you already know this. The moment you see this, suddenly you should become more alive, awake. What is that? Interest is given, financial leverage is given. Is there any connection? Interest and financial leverage. Yeah. Financial leverage ka what is a normal formula? EBIT by interest, or rather EBIT divided by EBT, correct. But now will we use the same formula or substitute? Substitute. What is that substitute you will do? Instead of saying EBIT divided by EBT, instead of EBT, what you will write? EBIT minus interest. Financial leverage is given in the question. How much is that? 5. EBIT we don't know. Interest is given in the question. How much? 14,000. Solve. This you send it. 5 into EBIT will become 5 times EBIT. 14 5s are 70 is equal to EBIT. When you solve, you will get EBIT as 17,500. Done now. So more or less, one if you solve means the problem will be over. Okay, now just check if you want. I've prepared both A and B in same format, parallel format. If you want, you can present separately. First thing, what I told people, fill out the data. What and all is given? Variable cost, fixed cost, interest. So first fill that. Variable cost given, and then fixed cost given, and then also interest given. Whatever is given, I have just updated. What did we get now just now? EBIT. How much we got it as EBIT for first company, A Limited? 17,500. Go ahead and immediately when you get the data, go ahead and fill it out. EBIT, now we got 17,500. Interest you already know. That means you can fill out all the balance portion. From these two, if you minus, you will get EBT. Interest tax rate is given in the question somewhere. Check. Tax rate is how much? 30%. So reduce tax rate, you will get earnings after tax. Preference dividend not there. So you will be getting each. You can stop at each because they have not given number of equity shares. So you can't calculate EPS. Or you can leave dash dash. Dash dash here refers to no information given. Okay, people. That means from what portion to what portion we have filled. From EBIT to bottommost number, fully we have filled. Then see if you can fill out anything else. EBIT you found, FOC was given. So can't you find contribution? Sir, from this you have to reduce 26,500 and get 17,500. These two are given means what is contribution? These two ka minus or these two ka addition? Add these two, you will get what? 44,000. Because only from 44,000 if you reduce 26,500, you will get 17,500. So it's, you want to put a working note for this or very simple? Simple means show it here only. These two you add, show the addition over here and write the value. Okay now. This is 44 and variable cost is 88. That means what is sales? Minus add. These two you add. That's what we got. And sales. That means income statement for A Limited is double. Just only based on one connecting point, which is financial leverage and interest. That ICAI uses in many leverage questions. So don't forget that connecting point. They asked only for A or also B. Now see what information they've given for B. Variable cost, they told us 50% of sales. So you already know the equation. From sales, if you reduce variable cost, you will get the contribution. Now check. If suppose sales is 100. If suppose sales is 100. How much will be variable cost? 50% of sales. 100 ka 50% how much? That means contribution also has how much? 50. So is there any relationship here? Check. Variable cost of 50. Contribution also 50. That means they are different or same. That means can I write if variable cost is 50% of sale, contribution is also 50% of sale. If you do 100 ka 50%, automatically you will get 50. Done now. This is one connection. Fine. Interest expense given. Interest expense given. Then they give margin of safety. Using margin of safety, can you find any leverage? Operating leverage is 1 divided by margin of safety. So using this, we can find margin of safety. Tax rate they've given. EBIT they've given. Awesome. So two datas they've given, we can fill it out. What are those? Interest to EBIT. Interest is 11,000 given and EBIT is given. How much is that? Something else they give. EBIT is 14,000. Interest is 11,000. That means bottommost portion taka I can fill now. From EBIT if I reduce interest, these two are given. From EBIT if I reduce interest, I'll get earnings before tax. Tax rate is 30%. So you also know earnings after tax. Preference dividend not there. So each is 2001. So from EBIT all till the bottommost number we have filled it up. Now the only thing is to figure out the uppermost portion. How? They gave margin of safety. Using that what we can find? First find that. OL is nothing but 1 divided by margin of safety. Done now. Okay. What is margin of safety ka normal formula? Operating leverage ka normal formula. Contribution by EBIT. Do you know EBIT? Yeah, they only given in the problem. How much? 14,000. Operating leverage just now you found. EBIT any which way they have given. So using these two what you can find? Contribution. Operating leverage is contribution by EBIT. Operating leverage we found it to be 4. EBIT question only they have given 14. So what is contribution? 56,000. Done now. And variable cost, once again, go and fill it up. How much is the contribution? 56,000. Sir, EBIT is 14. Contribution is 56. Therefore, FOC has to be what? 56,000 minus 14,000, which is 42. Done now. Now, if contribution is given, can you find out sales? They told variable cost is 50% of sales. They told variable cost is 50% of sales. Therefore, contribution is also 50% of sales. Contribution amount, you know, contribution is 50% into sales. Therefore, sales is what? 56,000 divided by 0.5, which is 1,12,000. Done now. Any problem? So, sales is 1,12,000. This you know. That means variable cost, you can arrive it as a balancing figure. That's all as this question. A simple questions. Like this, no, usually if they want to make it more build up, they will give them more missing figures they will add, which can make the question little lengthy. Okay, but otherwise leverage, yeah, it's overall manageable topic. Last 2-3 attempts they have asked leverage some good little brain spinner wala question. Otherwise, usually leverage you expect pretty straightforward questions only, because it doesn't make sense to ask too complex question from leverage because it comes only for 4 to 5 marks. So usually they keep it very simple. Only in very rare attempts leverage they kind of twist and turn. We will see in one of this attempt RTP. They try to make a little twist out of it. But okay, fine, we can manage. Yes, sir. Now, okay, everybody sorted. So I think this we have done our today's target. I think we have completed. This is a repetitive question, so it's fine. All right, people. Thank you.